Most people hear words like S&P 500, Dow Jones, or Nasdaq and think they're complicated financial terms that only analysts understand. But stocks indices are actually one of the simplest concepts in the entire market. In fact, you interact with them all the time, on the news, on social media, even when you check the economy's pulse, without realizing how straightforward they really are. A stock index is simply a group of selected stocks combined into one single number. That number tells you how that group is performing overall. Think of it like a scoreboard. Instead of tracking every single company, you track the score of the whole team. Imagine trying to follow 500 different companies every day. It would be impossible. That's why indices exist. They simplify the market. With one glance at an index, you can see whether the overall market is rising, falling, or staying flat. The most famous index in the world is the S&P 500, which tracks 500 of the biggest companies in the United States. When the S&P 500 goes up, it means the majority of these companies are doing well. When it goes down, the majority are declining. Then we have the Dow Jones Industrial Average, one of the oldest indices. It tracks just 30 major companies, but these companies are giants. For many decades, the Dow Jones has been used as a quick snapshot of overall economic health. And the Nasdaq 100 focuses heavily on technology, companies like Apple, Netflix, and Tesla. When people say tech is booming, they are usually looking at the Nasdaq. Think of stocks indices like playlists. The S&P 500 is like the top hits playlist. The Nasdaq 100 is the tech favorites playlist. The Dow Jones is the classic icons playlist. You don't need to listen to every song to know the vibe. You just check the playlist. One of the biggest advantages of indices is that they represent a collection of companies, not just one. That means they are already diversified. If one company performs poorly, the other helps balance it out. This makes indices so much more stable than individual stocks. Now, here is something crucial. Indices don't trade directly. You can buy the S&P 500 itself. Instead, you buy or trade instruments that track the index, things like ETFs, futures, or CFDs. These instruments are designed to copy the movement of the index so you can participate in its price action. Stock indices reflect the health of the economy because companies react to real-world events, interest rates, inflation, jobs data, earnings, global tensions, and more. Every time something big happens, indices react instantly. Indices also follow a clear market structure. They form trends, consolidate, break highs and lows, grab liquidity, and create displacements just like any other market. This is why technical analysis works so well on index charts. They reflect collective behavior, and human behavior leaves patterns. Another interesting part of stock indices is how they are weighted. For example, in the S&P 500, large companies like Apple or Microsoft have more influence than smaller companies. If Apple rises significantly, it can lift the entire index. If it falls, it can pull the index down. It's like a group project. Some members count more towards the final grade than others. Indices also move directly depending on the sector they are composed of. The Nasdaq reacts strongly to tech news. The Dow Jones reacts to global economic update. And the S&P 500 reacts to everything because it covers almost every major industry. Now, let's talk about traders. Why do traders love indices? Because indices are highly liquid, less manipulated than individual stocks, more stable for long term, cleaner from a structural and technical perspective, and they trade nearly 24/5 when using futures. Day traders often focus on index futures like the S&P 500, ES, Nasdaq, NQ, or Dow YM. These markets move fast. follow clean patterns and react to news instantly. At the same time, long-term investors prefer index ETFs like SPY or QQQ because they offer slow, steady growth. Indices help you see the bigger picture. Even if you're trading forex, crypto, or stocks, keeping an eye on the major indices help you understand the market environment. A rising S&P 500 can lift risk on assets everywhere. A falling Nasdaq can drag tech stocks down globally. Let's tie everything together with simple samples. Imagine you want to know how the US economy is doing today. Instead of looking at 100 of individual stocks, you simply looked at one chart, the S&P 500. If it's strong, confidence is high. If it's falling, investors are nervous. One number summarizes the mood of millions of traders, billions of dollars, and hundreds of companies. That's the power of stock indices. So, to summarize, stock indices are a group of selected companies combined into a single number. They represent the health of markets and economies. You can't buy the index itself, but you can trade ETFs, futures, and CFDs that track it. They are diversified, efficient, and widely used by both traders and investors, and they're one of the most important tools for understanding the global markets. Once you understand indices, the market becomes far less chaotic. You see patterns, connections, and behavior that once felt random. Indices simplify everything. They turn noise into a story, and that story tells you what the market is truly feeling.